occupies an interesting spot in the QSR NNN category. It's a fast casual brand with a multi-day part revenue model backed by JAB Holdings, one of Europe's largest private investment firms. If you want a QSR NNN deal with larger building square footage, strong catering revenue, and private capital backing, Panera is worth understanding. Here's the full picture. Panera NNN properties trade at 5.5% to 6.25% cap rates, reflecting the private credit profile, which is generally treated as strong given JAB Holdings' capital depth. Buildings run 4,000 to 4,500 square feet, noticeably larger than Starbucks or Chipotle, which provides more re-leasing flexibility. Entry prices range from $2.5 million to $5 million. Lease terms are 15 years with renewal options and rent bumps of 5% to 10% every 5 years. JAB Holdings also owns Pret a Manger, Keurig, Dr. Pepper, and other well-known brands. So the parent company capital is substantial even if it's not publicly rated. Panera's investment thesis starts with the multi-day part model. Unlike Taco Bell or Wendy's, which skew heavily to lunch and dinner, Panera generates meaningful breakfast revenue along with lunch and dinner, 3 income streams rather than 2. The catering business adds additional revenue diversification that traditional QSR can't match. JAB Holdings provides serious private capital backing and has the financial wherewithal to support Panera through competitive cycles. The larger building size, 4,000 to 4,500 square feet, gives you more flexibility for alternative use if Panera ever exited, compared to the 2,200 square foot Chipotle or 1,500 square foot Starbucks prototype. Panera leases are NNN with 15-year initial terms and renewal options. Rent bumps of 5% to 10% every 5 years. The corporate guarantee comes from Panera Bread or the applicable parent entity. Verify which entity is on the lease, as the guarantee structure from JAB Holdings corporate structure can involve intermediate holding companies. Drive-through versus inline configuration matters significantly. A drive-through Panera is a meaningfully stronger investment than an end cap or inline position. 3 things to watch with Panera. First, Panera is a private company. JAB Holdings does not publish public financials, and Panera itself went from public to private in 2017. You're relying on JAB Holdings' reputation and Panera's market performance rather than SEC disclosures. Second, fast casual competition is intense. Chipotle, Shake Shack, Sweet Green, and dozens of regional concepts are all fighting for the same consumer dollars. Panera's differentiation through its bakery cafe format and loyalty program is real, but the competitive pressure is worth watching. Third, labor cost inflation hits Panera proportionally harder than fast food due to the dine-in model. Verify the drive-through configuration to mitigate this risk profile. Panera NNN can work well for investors who want fast casual exposure with a private capital parent and more building square footage than typical QSR NNN. I'm Ryan Solberg with MaxLife Commercial. If you want to evaluate Panera NNN properties in Florida, let's talk through the specific deal. Visit maxlifedevelopment.com or call 321-586-2121.